Hi everybody, Jeff Rivett, Portfolio Manager at Cree Capital Management Group with National Bank Financial. Hope that everyone had a wonderful holiday season and a very happy new year as we gear up for 2024. Just a couple housekeeping items I wanted to touch on with regards to your investment portfolios heading into the new year. First off, tax-free savings accounts. The contribution limit for 2024 is $7,000. If you've let us know that you'd like us to do that for you automatically, if you have a TFSA account with us open, certainly we'll be doing that shortly. If you're not sure or you want to find out about opening a TFSA or contributing to your tax-free savings account, certainly reach out to us and we can help with that. Secondly, RIF accounts for my retired clients. RIF minimum amounts, so the minimum that you have to take out for 2024, that's calculated at the beginning of every year. That is currently being calculated now. If you'd like to know what that amount is, certainly reach out and we can let you know that number. Third would be the tax season. I know we're in the second week of January and already I've had a few people reach out about tax questions for 2023 taxes. We do have access or limited access to some information. Things like if your accountants are looking for management fees, gain losses on securities, and foreign property reports, we have access to that information. However, things like T3 and T5s, interest income, dividend income, trust income, those will be coming out in February and early March. So still some time on that. Now, with regards to the markets and our expectations, I'll be touching on sort of a bit on 2023 and our expectations for 2024 in this video. But just wanted to also invite you to attend our upcoming webinar next week on Wednesday, January the 16th at 2 p.m. Eastern Time, which will be hosted by one of our strategists at National Bank, talking about what the expectation for the bank is in 2024 and how the bank is seeing the year shape up and how we want to position portfolios. Now, 2023 for us was great. Our balanced model returned on average about 10% return. We saw positive returns in really all asset categories across the board, which was just great to see. For us, we especially saw outperformance in U.S. equity and in preferred shares. Now, preferred shares are an area that is close to my heart because I think it's a real opportunity for us as a group. It's an area that I've been trading now for 15 years. It's a relatively small niche area. It's obviously, several $100 million or probably over close to $1 billion in size. But all in all, it's a relatively small area and it's an area we continue to be able to take advantage of. And this year was no different. We started the year with very little exposure to preferred shares as they were sort of falling throughout last year, and we took advantage of some of the low prices really all throughout this year. And we saw high teens returns in a lot of those investments that we own, which was great to see and really helped out our fixed income performance. In the U.S. equity space, the U.S. market was dominated by what's now being called the Magnificent Seven, which is Tesla, Meta, which is Facebook, Amazon, Apple, Google, Nvidia, and Microsoft. And so those seven companies together are massive and got more massive. The return, if you just had a portfolio equally weighted of those seven companies, you would have made about 76% last year, which is phenomenal. Now, don't talk about the year before because all those companies had almost equally bad years in 2022. So really, it was a case of a massive sell-off in 2022 and a huge rebound in 2023. Now, in our portfolio, we had exposure to Amazon, Apple, Google, and Microsoft throughout most of the year, with Microsoft a position that we continue to believe in due to their stake in ChatGPT and their exposure to artificial intelligence, inclusive of everything else that Microsoft does. Because of that focus in our portfolio, we were able to perform extremely well in the U.S. part of our investments and actually beat the U.S. market with the U.S. names that we own, which I'm very proud of. But overall performance, like I said, last year was strong across the board, and it was a rebound almost entirely of what, or almost the reciprocal again of what we saw in 2022 in our balance model too. Again, 2022, a year where we saw equity sell off, fixed income sell off, and just a year that everyone would like to forget. 2023 brought us almost back to even. Now, again, strong 2023. However, viewed over a 2-year period, we're basically back to where 2021 ended as far as portfolio numbers go. So that is just case in point of where the world is the last 2 years. We certainly did everything we could in 2023 to take advantage of what was offered. Now, as far as positioning for 2024 going forward, we did finish 2023 with a focus in the fixed income space, taking advantage of long-term U.S. Treasury bonds. One of the things that I really started talking about back in November was this expectation that interest rates would be coming down, which indeed that they have and continue to do so, and us wanting to try to be ahead of that and really take advantage of high interest rates in safe investments. So we were able to buy into long-term U.S. Treasury bonds through the iShares TLT ETF in November. And at the time, we were able to get interest rates over 5% for long-term bonds, and that seemed like a heck of a deal that I wanted to lock in, with the added bonus that if interest rates did continue to fall, we would benefit from that, and certainly we did, and we saw high teens returns from that fund in just 2 months. So one of the things that we started working on at the end of last year in preparation for this year was taking some of the profit from that, because quite honestly, it did much better than we expected in a short period of time, and sort of reallocating that into some of our favorite investments. Now, we do rebalance the accounts regularly, meaning that if we have certain investments that are doing extremely well, we'll take profit in those and add into the investments that we believe will do well but maybe haven't yet. And in doing that, we hope to maximize the return that we get with less risk. Now, there's some investments that have done extremely well, companies like Amazon and Google and Microsoft, that we don't really want to trim. We want to keep holding on to what we have of those. So for those investments, we did increase our allocation, but really just to match the size that those companies have become in our portfolio because they've done really well. Other companies that we added to that we really like right now, Visa, Nike. We continue to like Disney. It's had a good rally, and also Diageo, which is a company I spoke about in December. One of the world's biggest liquor companies is still at a massive discount, and we think that that's going to provide excellent risk-adjusted return over time. Now, overall in our model, we are still underweight in equities. We're at about 54% in the balance model. And again, we can be as high as 65%, so still a very cautious tone. And that's largely because even though things are going really, really well, there is a few headwinds in 2024, and they're the same headwinds that we faced in 2023, but perhaps now they're even more of a headwind because the markets have done so well, and really now the expectations are really high that things are going to go good. Now, what companies are really going to have to push through and show that they can continue to grow profits through to justify their valuations and continue to see equities grow, are number one, increasing wages. That's going to put pressure on profits. Number two, high borrowing costs are still persistent. And number three is potentially a slowdown in spending. And that's a trend that we haven't really seen take hold yet, because people are spending like they've never spent before and spending like crazy because of all the money that was built up during COVID. But we do expect that 2024 could be the year where we start to see people say, okay, that was fun. We went on our trips. We went to Europe. We went to Disney. We did all that stuff. We bought new house, new car, whatever it is. now is time to sort of start to maybe take a look at our budget again. And so we do think that there'll be a bit of a spending slowdown in 2024. So again, just being cautious with the equities and just being really choosy with the names that we own. We do still really love the fixed income space. Specifically, we really love preferred shares. We've got about a 10% weighting in preferred shares. Again, really good income that we're receiving in that space, and still at a discount despite the success we've had in there. So we are overweight in fixed income. Again, it's one of those situations where if we can take advantage of high rates for us, meaning that us as lenders are able to receive good income from those investments, and we can do that, receive a 4, 5, 6, 7% distribution depending on the fixed income investment with relatively low risk, then why wouldn't we do that? And so we're going to continue to try to maximize return for the least amount of risk possible. So we're making those changes now. We're certainly I'm going through reading up on sort of all the takes in the world and how things will shape up as 2024 takes off. But we'll certainly be keeping you posted throughout the year. I'm always available to speak to you if you need me. You know where to find us, or anyone else on our team who'd be happy to help answer any questions you have on your portfolio specifically. And if nothing else, you know where to look us up. So wishing everyone again a happy new year. Hope that everyone has a nice January. Stay warm. It's going to get cold, and look forward to touching base with everyone in February. Take care. Thanks. Bye bye.